Accounting treatment when no separate set of books is maintained. As we discussed before, if a separate set of books for joint venture is not maintained, each co-venturer will keep the accounts along with his own books of account. Under this kind of accounting, there were again two methods. One was where all his transactions are kept in his own books. That means each co-venturer in his own books. He has his own books of account, he has his own journal, cash book, ledger, etc. Along with that, all transactions relating to the joint venture are also incorporated in his books. The other method was by which he keeps records only of his own transactions and does not keep record of the transactions engaged in by the other co-venturer. In that case, he needs to prepare a memorandum joint venture account through which he ascertains the profit or loss on joint venture. So let us do these one by one. First, let us see what are the accounting entries when record of all transactions are kept by each co-venturer along with their books of account. In this case, the accounts prepared are like this. One is a joint venture account and another is the co-venturer's personal account. So a joint venture account is a nominal account. It will give us the profit or loss on joint venture. All expenses are debited to the joint venture and incomes credited to the joint venture. And there is another account, the co-venturer's personal account. Like we did Akash and Bikash. In Akash's books, there will be Bikash's account, and in Bikash's books, there will be Akash's account. Let us look at the accounting entries. First, this is a system by which all transactions relating to the joint venture are being recorded by each co-venturer in his own set of books. So first, for supply of goods from own stock. That means if Akash sends his own material to the joint venture, the entry would be joint venture account debit to purchases. Since the goods materials, assuming that the materials he has purchased has been debited to purchases account before. So now since they are being used for joint venture, we remove it from purchase and take it to joint venture account. On the other hand, if he does spend money for the joint venture, buying material for the joint venture, buying equipment for the joint venture, meeting the expenses of joint venture, if any money is spent by him, since it's an expense, joint venture account would be debited and it's his own personal cash going out. Therefore, his cash or bank account would be credited. The same thing may be done by Bikash. If Bikash spends money or if Bikash brings materials from his own business, then what is the entry that Akash would pass? Akash would say joint venture account debit to Bikash's account. In this case, Bikash. He would say to Bikash's account. So he's crediting Bikash's account whenever Bikash meets any expense. This credit to Bikash's account represents the money which is payable, which is ultimately due to Bikash. When goods are sold, if goods are sold and Akash himself is getting the money, in the books of the co-venturer receiving the money, the entry would be bank account debit to joint venture. And of course, if it is credit, you could use a debtor account debit to joint venture. Why is joint venture credited? Because it's a sale, it's an income, and therefore joint venture is credited. Bank account or debtor account is debited. If goods are sold by the other person, if goods are sold by Bikash, well, how would Akash record it in his books? Akash would say Bikash's account debit to joint venture. Why is that? Again, it's an income, therefore joint venture is credited. Since this money is received by Bikash, Bikash's account is debited. For materials or asset which are withdrawn for the business. For material or asset withdrawn for business, joint venture account is credited and the purchases account or asset account is debited. Suppose we remove furniture. If Akash takes over furniture and he intends to use it as furniture in his business, it becomes furniture account debit to joint venture account. Similarly, if the materials are withdrawn by Bikash, then we say co-venturer, Bikash's account debit to joint venture. Bikash's account debit to joint venture. After passing of these entries, the joint venture account would reveal the profit or loss. When it's a credit balance, the joint venture account would indicate a profit and we would close the account, joint venture account debit to profit and loss account to co-venturers account. So in Akash's books, profit and loss would mean Akash's share. And this would be Bikash's share. To co-venturer, that is Bikash's account. I am assuming Bikash is the co-venturer. It would be Bikash's account. So joint venture account debit to profit and loss to co-venturer's account. In case of loss, of course, the entry would be reversed. Joint venture account would be credited. Profit and loss account would be debited with Akash's share in Akash's books, and Bikash's account would be debited in Akash's books. And for the final settlement, it would be Bikash's account debit to bank or bank account debit to Bikash, however the case is, whether money is receivable or money is payable. So here there is no other account. Basically, we are concerned with the joint venture account and the other co-venturers account. Joint venture account is debited with all expenses and credited with incomes. For the venturer spending his own money, bank account is credited. When the other co-venturer spends money for the joint venture, his account is credited. The joint venture account reveals profit or loss.